a lot of people, a lot of traders, including myself as well, have placed so many times where it affected a lot our risk exposure to the market. So what are these 4 things? So the first things first, the number 1 is going to be, what's good guys, it's your boy Trade Forex, and here again with another video. And today's video is going to be about another key important aspect of the risk management, which is the stop loss. And I made another video about the break even. If you guys haven't watched that, I'd highly suggest you to watch that as well. And the next one is going to be about the TP, your take profit. So this being said, what we're going to do today, starting with the first one, when we say where to place and why, there is no an universal rule that says where exactly you have to place your stop loss. However, you have to be able, first of all, to have a very solid technical background. So you have to understand at least the very basic of how price moves from point A to point B. All right. Now, once you know this, you have to start then understanding what keeps this price to be valid from point A to point B. So what do I mean is that, let's take a structure or order flow because it's the one that I use the most. So for example, if I have a point A, which is my low, that means the high, which is my point B, I know that this low, that is my point A, is the reason why we had now this push to the upside. Therefore, technically, right, from a technical perspective, if I think that now price need to keep going higher, I know the price must retrace inside this zone and then keep pushing higher. Therefore, this is already telling me that if I take an entry here and I put a stop loss below this low, objectively, this is a valid place to put my stop loss, because I know that if price in any case violates this level, then it will definitely change the momentum of the market. Therefore, if they change the momentum of the market, my analysis is getting validated. Therefore, I can no longer look for a buy. So it's pointless for me to take a trade here and, I don't know, maybe keep a stop loss somewhere below this low because I'm scared. So now this is the big zone where I will be putting my entry and putting my stop loss. It's pointless. Why? Because I know the order flow is bullish, right? So from a technical perspective, that's the level the price has to respect in order for them to go higher. If that's getting validated, that's it. My stop loss is hit and I have to accept that. So do you understand what I'm saying when I say you have to know where to place it and why? And obviously the same can go for you if you're trading, let's say, support and resistance. So now, oh, sorry guys, that was an alert that got triggered. All right, anyway, so now the same goes for support and resistance. So if let's say you got your support and a resistance and you have another zone over here, you can place an entry here because you might expect price to hit your support or resistance, then give your reaction away. So therefore, if you have a stop loss over here, that's safe. But if for whatever reason you have your support and resistance, they get broken, and then you have like body closure, because I know who the people that trade support and resistance, they always look a lot the acceptance of the price above certain level, then you know it's literally pointless now for you to have your stop loss even beyond this level to the upside, right? Why? Because now price most likely is going to go higher. It's not going to go down anymore. So that's what I meant when I say you have to have a very solid understanding of where to place it and the why. So where to place it, it comes from your technical point of view, your technical way of seeing the market and understanding what is holding this specific level from point A to point B. And the why is because of the bias, because price can only go up and can go down. That's it. So if you know that you're putting it here, is because you are not to protect your stop loss, or you're trying to place your stop loss in a valid area from where price can go higher. So that was the point 1. Now, moving to the second point, which is the 4 things to consider must when placing your stop loss. I think this is very, very crucial because these 4 elements I'm going to discuss now, right, are the key elements that a lot of people, a lot of traders, including myself as well, have placed so many times where it affected a lot our risk exposure to the market. So what are these 4 things? So the first things first, the number 1 is going to be about the spread. So understanding the spread, okay? So why spread is important is because sometimes, okay, if you trade so many pairs, like you have a list of a lot of pairs on your watch list, and then what you do is that you take, for example, the major pairs. Most of the time, the major pairs, they have low spread because when you have higher liquidity in a specific pair, your spread is going to be low. When you have a low liquidity in a pair, then you have a higher spread. So that means that if, for example, and this is something that you have to be able obviously to distinguish, which is in a sell scenario, right? So if this is a sell and this is the buy, right? Most of the time, not most of the time, majority of the time, actually always, when you take a trade, so let's say this is your extreme, you have to always, is a must, especially if you're trading the minor or exotic pair, you have to always take in count your spread. You cannot take a trade, let's say from this zone and putting the stop loss just above it, because many pairs, like for example, I don't know, Arrow NZD here, Arrow Card, and yeah, like I got a lot of those pairs, but those are just for data collection and backtesting. So what happens is those pairs, usually they have like more than 1 pips or even 2 pips as a spread. So what happens is that if price comes inside your PY, let's say it comes at a deep retracement and it makes a sort of equal over here and your stop loss here, there is a 99% probability, if not even 100, that price will definitely take you out on those pairs because of the spread. So for example, if price is here, most likely the spread is going to be over here. So that's something very, very important to consider when it comes to set your stop loss. And when it comes to the buy scenario, however, is a bit different. So what I mean is that on the buy scenarios, your spread is going to be here, while your actual price is going to be here. So in that case, what you can do is like you can keep your stop loss below the low over here, right? However, your entry has to be slightly higher, especially again if you trade like minors or exotic, because you have to make sure the price, when it gets in, it gets the price and the spread below your entry level. So in this way, you will know the price will be filled. But why this is important, because me, when I started trading at the beginning, I was seeing all the pairs in the same way. So when I was taking the trade and putting my stop loss just above the high, because I was following my Y, okay? So the point 1, what used to happen is the price used to come here and then used to go away. And I was like, okay, what's going on here? Why is it hitting my stop loss? I didn't even touch it. Well, guess what? Because of the spread. So that was the point 1. Now, let's move to the point 2. We go to point 2. What we got in the point 2 is that opening of the market. Now, this is something that I got tricked so many times. And what do I mean? I'll make an example. I'll show you on the chart later. No worry. Is that when you, again, trade like structure, let's say structure or even support and resistance, you have to always pay attention, right, to the low. So what do I mean to the low is that you have to make sure that this week or even this week, this low is not the opening of the market. Especially it can differ from brokers to brokers. So sometimes when you go to the Asian session, when the market resets every day, what happens is that you might have a huge hook to the downside, right? Or even in this case, let's say it breaks to the downside like this, or you feel like, oh, that's a break of structure. Now the very next day you try to short from here. So what happened is that actually that was not a break of structure, because that was just an open of the market. So it was probably a sort of liquidity rate. And sometimes what happens is, like, as I said, it differs from brokers to brokers. Some brokers you might see price going down, respecting this level. Some other broker you would see probably price going all the way down here and then shooting all the way up. So now the very next day when you wake up, you'll be like, okay, maybe that was a stop hunt. So, you know, I can go for a buy. But in reality, there is no such thing as a low, because what the price is doing is respecting this level over here. Do you guys understand what I'm saying? So this one is so important because it actually confuses a lot of traders as well, myself included. Sometimes when I was taking a trade, I was like, oh, that's beautiful. I have a low, I have a high. So what used to happen is price used to come all the way down here. I'm like, wait, 1 second, why price came over here? Well, simply because the real low, the real move was this one, wasn't this one. No worry, I'll show you an example on the chart so you guys can understand what I'm talking about. But now let's keep moving with the points. Now, what is the number 3? When it comes to the number 3, right, we have the most important one after the spread, which is the slippage. Yes, you heard me right. Slippage is probably one of the most dangerous things, especially when you have news on the way, because when you have a news, as I said on my many times, you guys have to be very cautious on taking the trade. Better not taking any trade, but if you do take a trade, make sure you apply your break-even protocol or take some partial to make sure that you protect your capital. However, when it comes to the slippage, like, you might have a very big problem, because sometimes, let's say that you go with the order flow again. So now let's say it's a sell scenario comes over here, right? Price comes here, right? And then let's say you go for some sort of limit or some sort of buy stop or sell stop. So price instead, so you have a price here, you go for a sell stop. Instead of activating your price over here, probably price activates your entry over here. Right? So what happens is, like, because of slippage, and this is a sell stop, I'm talking about sell stop. And then what happens in that case is that your stop now gets bigger. Even if you have your stop loss over here, your stop loss, because of the slippage, your risk exposure is go higher. So instead of having, let's say, 1% risk here, now you end up having 1.2 probably, right? Or maybe 1.5. It depends from the slippage. And then if you have a news, that's even worse, because if you have a news and something big like goes against your trade, what happens is that the stop loss, instead of getting closed here, most likely it will go above here. So you end up losing like 2, 3, 4, 5% as well. And trust me, that happened to me so many times. That's why, based on my experience, I can tell you, like, do not make these mistakes when it comes about taking a trade during the news. Make sure that if you are inside the trade, go break even, take partial, and save your capital. That's it. Don't overcomplicate that. And also another important thing is when you take, like, for example, another thing actually is that slippage of the advantage. So when, for example, you go for a sell scenario again, let's say you have your price over here, and then price, because of the news against the slippage, it opens all the up here. Now this is a plus point for you, because in this case, if now price plays in your favor, it's fine, you make your money. But if it is a stop loss, then you're gonna lose less. Unfortunately, that's a case that doesn't happen every time. Probably most of the time, the slippage will make you lose than make you money. All right, so that's the point 3. And then now we're moving to the 4th one. Again, this one as well is very important, and I used to underestimate that a lot. And what is this about? Is all about understanding your broker. Now, what do you mean by your broker? Is that there are so many pairs over here, right? And every pairs are provided from every pair's data are provided from specific brokers, and those brokers sometimes, not many times, they have a very slightly differences on how they provide and deliver the prices and how they shows us the data. And why this is important, again, is almost the same as I told you over here about the Asian opening market, because sometimes if you have price like showing you this, right, it might show you break of structure, and then what happens is that it comes all the way above here, then you place your entry. And how many times you had a circumstances where you were like, oh, I'm placing my entry, the level is correct, so let's say now it's 5, 6, 8, 7, right? So if you look at here, let's say 5, 6, 80, whatever, you're like, oh, okay, it tapped here on the chart, but it did not tap on my MetaTrader. How is that possible? Well, it's because of the differences I'm talking about, right? So this is a very big problem, and this is something that you have to always make sure that you cross-reference within every pair that you're trading, because so many times I had the cases where not only price was not even filling my orders, but sometimes price was even hitting my stop loss, and I was like, okay, well, hold a moment, what happened here? Like, how come how come I hit a stop loss, right? And price just went my direction without taking out the highs. Well, what actually happened is that on my broker, when I place the stop loss looking at this blue line over here, you see, actually the broker on my MT4 was probably showing the data somewhere around here. So what happens is that when price hits that, it just takes me out, and then it goes on my direction. So those 4 elements that I just stated, so let me just summarize it quickly, which is the spread, which is the number 1. Then we have the market open. So as I said, market open, sorry for the typo, all right, market open. And then we have the 3rd one, which is the slippage. So we say the 3rd one, slippage, right? Okay, all right. And then finally, the last one, we said about the broker difference on their pips, or the way they deliver the prices. Okay, so those 4 key elements are probably some of the most important things that you have to make sure that you have it under control with your trading journal or your trading plan, because trust me and believe me, I'm pretty sure you can relate yourself at least in one of those, and I went through all of them. So that's why I know that this kind of scenario can affect a lot your risk exposure and the way you manage your risk taking a trade. Now, this being said, I'll show you another important thing, which is the data collection, and ask yourself the right question, the bullet point 3. Let's jump to the chart. I'm going to be showing you something very important, and yeah, let's move to it. So now, if we go to the data collection, okay, 1 second, what was the 4 point? The 4 point, okay, yeah. So now if we go to the data collection, which is somewhere, okay, so I'll show you something, a trade that I've taken, right? Okay, here we go. So this is a trade that I've taken Audit HF, and let me show you what happened over here. And yeah, so I'm not going to break it down why I've taken the trade for a buy. As you can see, eventually price played out in my direction. Probably by now it would have been a break even. After reaching 1 to 10, I would have taken probably some partial and then let it run. Now, what you can clearly see here is that what I say is that look at this. So price breaks to the upside, then comes to the downside. I take the trade, and then eventually price wicks me out and then goes on my direction, right? So now what happened is that first thing first, I had to make sure that this week, this low was at 2 o'clock. So 2 o'clock means that this low for me is valid, is legit, and it's not market opening. So every time now on, always check out and try to see, because usually UK time they open at around 10 o'clock. So you can see this was around 10 o'clock, this was at 2 o'clock. So this low is a valid for me. I can validate that it's not market open, so I can take a trade. Therefore, I left a pending over here. So that was the first thing. And the second thing is that I left a bit of space over here, right? Approximately 0.5 pipette, 6 pipette, just to give a bit of breathing room. But what happened is that as soon as price took me out over here, right, I did not take any more trade for a sell because I was still looking for bullish. Price broke to the upside, so I was like, okay, I need to wait for another bullish pattern to happen before I take the trade. Now, why I'm showing you this is because here I'm going to conclude with the point 3 and the point 4. So the point 3, I say data collection. Now, a lot of people can argue and tell me, why did you not move your stop loss a little large? Like, why did you not take your trade like this, giving a little bit more breathing room, okay? Or, you know, why you left it just like below it? Because I had a lot of people sometimes commenting and saying, oh, you are too tight with your stop loss, you have to go a little large, put it a little bit, you know, larger, give a bit of breathing room and this kind of stuff. Now, I'll give you some logical reason why you should never do that. First and foremost, remember when I said the point 1, which is follow your why with your technicals. So for me, my why and my technical was this low made this high. Therefore, if we go higher, this has to be respected. So it's pointless for me to have a huge stop loss. That's one. Then the second thing is that I have to always keep in mind that every time that I'm making my stop loss large, and that was the point 4 where I say that, oh, if you increase your stop loss live trading because you're scared of hitting your stop loss, there are 2 key factors that you're doing. The most important one is that you're now, instead of having, let's say, 1% risk exposure, you have at least nearly 2% or even 3%. It depends how big you make it. And then the other point, which is why I don't want to have the stop loss so big, is because if I do this, look at what happened on my risk to reward. So before, it was around somewhere like this, 1 to 10 approximately, 1 to 9, 1 to 10, and then now if I keep it large, it becomes 1 to 5. So you see how that's then just does not reflect the way it was the initial trade, right? And why this is important is because your risk management, your risk to reward defines your compounding plan, defines your account growth. So obviously, if you start messing around with your stop loss and you don't have a defined TP target based on your RR, risk to reward, you'll have very hard time in order for you to grow your account. So this being said, I think now I've highlighted to you the point 4, but I didn't say about the point 3, which is the most important one. So that was about the data collection. The data collection, so what I do in this case, if I have this scenario, right, where I put my stop loss over here, I said that so many people will be like, oh, just keep it large so you're not going to hit a stop loss or whatever. But what I do is doing the data collection, which is basically I try to see every time and how many times I get wicked out every time I'm taking a trade. So if I have a break of structure and I'm taking the trade from the extreme, I want to see in all the person I'm trading, in all the session I'm trading, in all the whatever I'm trading, is how many times on every setup I have this type of scenario where price takes me out and then goes in my favor, okay? And this is when it comes to data collection, because if I have this data and I have these statistics, let's say I'm taking approximately 100 trade, 50 trade, whatever I take, out of 100 trade, probably only in 20 scenarios, I have this type of cases, or maybe in 10 scenarios, or maybe even 30. But then the question is like, if I have 10, 20, 30 scenario like this, what is my risk to reward? Well, in average, is 1 to 10, 1 to 20. You guys been seeing the time I've been breaking down all my trades. And most of the time, there are 1 to 10, 1 to 20. So should I be really worried on me hitting 20, 30, or whatever stop losses just because this scenario happens? Do you understand what I'm saying? But if I had let's say a case where I was hitting 50, if not 40, or even let's say 70 times these type of scenarios, then I'll be like, okay, I think that's the wrong way for me to put a stop loss. So therefore, I need to make a little bigger, give a breathing room, and then I'll try to adjust a different way my risk management and my compounding, because obviously my RR now is smaller. So this being said, guys, I have wrapped out all the 4 elements for you, and I hope it gives you a bit of insight, a bit of understanding on how to deal better with all your stop losses. I didn't give you a unique, universal, like let's say stop loss way to place it. I just gave you the most tangible, the most concrete way for you to understand how to use your stop loss and how to take the best advantage out of it. And as I said, I'll be making a next video where I'll be discussing how to take your take profit, how to establish your take profit. And obviously I made another video about the break even. So if you guys haven't watched the video, is in the link above here in the description somewhere, probably right on the right corner above. So I invite you highly to watch that video to take more inputs and understanding on how to start building a narrative within your risk management, break even, and take profit framework.